Welcome to This Explainer. Today, we're taking a hammer to one of the biggest myths in the financial markets. So many everyday traders operate under this illusion that the big banks, the massive hedge funds, and all the institutional players are relying on some highly secretive, magical algorithm or a holy grail indicator that literally never loses. But the reality? Well, it's actually far more mechanical than that. Their real secret isn't a magic indicator at all. Their edge comes from a deep, fundamental understanding of market mechanics, incredibly strict risk control, and above all else, information flow. Let's pull back the curtain and see how the smart money actually operates. Now, if you've spent any time at all looking at charts, you have absolutely felt this exact frustration. You patiently wait for a technical breakout, you enter your trade, and almost instantly, the market aggressively reverses in the complete opposite direction, stopping you out right before continuing the exact way you originally predicted. I mean, it feels personal, doesn't it? It feels like the market is actively hunting you. Well, honestly, in a way, it is. The market is beautifully designed to prey on conventional retail strategies, and understanding why this happens is your very first step to finally trading on the right side of the tape. There's a totally stark contrast and focus here. Picture a retail trader's screen. It's often glued to messy charts with 15 overlapping indicators, desperately searching for that one perfect signal to enter the market. Basically, they're gambling on random price noise. But the institutions, they literally couldn't care less about your moving average crossover. Their focus is completely different. They're obsessively focused on liquidity, fiercely controlling their risk exposure, and having the supreme patience to just wait for the market to come to their specific pricing zones. So, to trade like a professional, you've got to shift your whole paradigm away from chasing magic indicators and start focusing on real market structure. All right, let's get right into section 1, the core mechanics, liquidity and structure. The real engine of the market is something called the liquidity sweep. You see, big banks simply cannot enter the market the way you or I do. When we hit buy, our order is filled instantly because, let's face it, it's tiny. But institutions, they're trading massive, billion-dollar positions. If they just slapped the buy button, they'd spike the price and completely ruin their own entry. They need massive volume to fill their orders without moving the market prematurely. So where on earth do they find that volume? They find it exactly where retail traders park their stop losses. They intentionally drive the price to sweep recent highs or lows, triggering all that panic selling or breakout buying. And that provides the exact liquidity the institution needs to fill their massive positions. Because of this dynamic, the execution styles between the two groups are completely polar opposites. Retail traders see a huge green candle and they chase it out of sheer FOMO, the fear of missing out. They enter emotionally and they end up overtrading. Institutions do the exact opposite. They identify very specific areas of supply and demand, what we call premium and discount zones, and then they literally just sit on their hands. They wait for the price to come to them, and if it doesn't reach their zone, they don't trade. It is a very deliberate game of calculated ambush, not frantic chasing. And this logic builds directly into how professionals view the charts. Institutions look at market structure with a mathematical, almost algebraic logic. Just think about the basic formula for a line you learned in school. Y equals mx plus b. Now, obviously, markets are way more complex than a straight line, but institutions still think in terms of structured, directional movement. They're analyzing the trend, the slope of those moves, the momentum behind the volume, and clear areas of continuation and reversal. They map the market logically, whereas retail traders usually just see a random series of erratic candles. Structure will always matter more than the lines drawn by a lagging indicator. Moving right along to section 2, the execution, cycles and zones. The market absolutely does not move randomly. It moves in very deliberate, repetitive cycles. The most common institutional framework operates in 4 stages. First up is accumulation. This is where price ranges sideways as the smart money quietly builds their position. Second is manipulation, a nasty fake breakout that traps retail traders and grabs that liquidity we just talked about. Third is distribution, where the smart money begins offloading or hedging their bets. And finally, expansion, the aggressive, real trend move. This 4-step cycle is exactly why so many massive moves begin with a period of boring consolidation, followed by a vicious fake breakout. Now, time is just as critical as price. Institutions aren't just sitting there trading 24/7. They're most active when the market has the absolute highest volume and volatility. Because again, that provides the liquidity they desperately need. This means they're active during the London session open, the New York session open, and especially during that sweet spot, the overlap between the two. Furthermore, they use major news events. Think CPI data, non-farm payrolls, or FOMC announcements. Retail traders are usually told to avoid the news because it's too volatile. But for the big players, that volatility is a tool. It's the perfect smoke screening to sweep liquidity and secretly enter massive positions. You've probably heard the term order block thrown around a lot if you've studied smart money concepts. So let's quickly demystify it. An order block is basically just a specific footprint left on the chart. It's an area of immense supply or demand where institutions previously manipulated the price to build their positions. Remember, they don't enter all at once. They scale in slowly, distribute, and manage risk dynamically around these blocks. Identifying these zones allows you to essentially piggyback on that massive institutional volume when the price eventually returns to retest that exact area. Now for Section 3, the real edge, risk and psychology. We've talked a lot about chart technicals, but the true edge, the thing that actually separates a profitable professional from a struggling amateur, comes down to the cold, hard reality of the business, risk and psychology. I absolutely love this analogy from the trading community. Your stop loss is a seatbelt. You don't put it on because you expect a crash. You put it on because if you do, you survive to drive again. Knowing that institutions intentionally engineer liquidity sweeps means you know the market is actively trying to take your money. Trading without a stop loss isn't brave. It's literally a mathematical death sentence. The pros know this, and they protect themselves relentlessly. Think about the profound difference in how these two groups manage risk. A retail trader might risk totally random amounts, sometimes going all in just based on a gut feeling. But an institutional trader, they're risking microscopic amounts, usually just 0.25% to maybe 1% per trade. When a retail trader takes a loss, they usually revenge trade to try and make it back immediately. The institutional trader hits a strict drawdown limit and just walks away for the day. It's a complete fundamental mindset shift from get rich fast to steady, calculated consistency. The absolute golden rule of institutional trading is that consistency matters far more than hitting one massive home run. Institutions know that losses are totally normal. They know no setup wins 100% of the time. Their goal isn't to be right on every single trade. Their goal is simply to survive long enough for their statistical edge and probabilities to play out over a sample size of hundreds or thousands of trades. And this is exactly why psychology separates the winners from the losers. Retail traders fail because they let greed, fear, and impatience run the show. They overleverage because they want results today. Professional traders, on the other hand, are emotionally disciplined, infinitely patient, and entirely objective. They view a loss as just a standard business expense. It's like drawing a red marble from a jar of probability, nothing more, nothing less. Mastering your mind is the ultimate secret to actually executing this institutional model. Which brings us to our final part, Section 4, the ultimate goal, capital preservation. This is arguably the most important paradigm shift in this entire explainer, understanding the actual primary objective of a professional trader. The ultimate goal is capital preservation. Most everyday traders enter the market trying to make money. Institutions enter the market to protect money first and make money second. By protecting their capital above all else, by prioritizing daily consistency over sporadic big wins, and by harnessing the sheer mathematical power of compounding, they ensure their career longevity. That mindset, protecting the downside so the upside can take care of itself, changes absolutely everything about how you interact with the charts. So we come to the end of our explainer with a pretty vital question, when you really need to ask yourself every single time you sit down at the screens. When you place a trade, are you aligning your entry with the structure and the patience of the smart money? Or are you reacting to emotional noise, placing your stops in obvious retail traps, and ultimately providing the very liquidity the institutions need to profit? The choice of which side of the tape you want to be on is entirely yours. Keep learning, stay structured, and start observing the market through the lens of liquidity.